With that done, it might feel like we finished a sales forecast, but it's very important that we also forecast our direct unit costs, which brings us to more class discussion. What would be the unit costs on coffee, lunches, beverages, and other? And you could see how that would lead to a good discussion that in itself might be useful, but I'm going to suggest that we can do better with Business Plan Pro. There are some bundled financial reports for standard types of industries that are built in that you can use to shed more light on the subject. To do that, I would go to the outline and I would go find my ratios. Now, you would find that in help if you didn't know it, but happily we're doing this together. So I'm going to click the ratios and you'll see we have more table settings to do. You only do the table settings once, but before you've addressed all of them, and I think we're going to get the last bunch here, before you've addressed all of them, yes, the financial model requires that we do some settings. So on this one, I'm very happy to have the chance to point out that we want the standard financials. That's your GAAP-approved accrual accounting as opposed to the cash basis financials. And let me explain in an instant the difference. Cash basis is very poorly named. It isn't cash basis. If you're on cash basis, then when you make a sale and deliver an invoice, nothing shows up on your books until that invoice is paid, which I would hate. I want my books to show that I've made a sale and I've got some money that people owe me. Also, when you receive goods and they give you an invoice but you haven't paid it yet, in the cash basis, nothing appears on the books until you actually make the payment. Well, I hate that. I always recommend accrual because what that means is we get an accurate picture of our financial situation, including what we owe and what is owed to us. The cash basis financials are there in Business Plan Pro because QuickBooks has the option of cash basis, and obviously there are some very small businesses that do nothing on accounts payable or accounts receivable. Everything is cash. So that's why it's there, but it's not a great instruction mode. So there you have my recommendation. Use the standard financials that plan cash flow better. And as soon as I click Next Task, well, now because we've just made that choice, there are some assumptions we have to make, like, okay, how long are you going to wait to pay your bills? Notice here we have 30 days. That seems like a good standard. That's the default. And so I'll click Next Task. And another very important one. I said as we set up this example that we were making it a restaurant that is in an office park and has business accounts with standard corporate customers because I want to show sales on credit. That's about accounts receivable and collection days. It's not credit card sales. It's delivering an invoice in a business-to-business mode to a company that will then pay that invoice 30, 45, 60 days later. So I'm going to definitely say in this example, yes, I sell on credit, and then we have to say how much. Let us just, for sake of instruction, take this 25% assumption and make it 75% of sales on credit. That will help us deal with that in cash flow. And then I'll click here, Next Task again. And how long do we wait before we get paid? Well, the assumption here is 60 days. We could click and make it 30 or 90 or whatever, but I'm just going to leave it 60 days. And then finally, do we manage inventory? Well, I'm going to, for sake of illustration, in this restaurant say yes. How many months of inventory on hand? I'm going to leave it at 1. That's a questionable assumption, but we'll leave it that way. I would think with food it might be less than a month, and you would 0.25 or 0.5 or something. But I'll leave it at 1. And then the minimum inventory purchase, I can't stand that because it's food. We could very easily do it, let's say $250. This affects the cash flow assumptions later on that Business Plan Pro will do automatically, but you have to give it the assumptions. Now on tracking other income and expenses, that's there mainly because QuickBooks has a other income and expenses outside of the normal operating income, and that's hard for us to do, so we won't do it. no, I don't need to track. Whoops, I clicked almost the wrong thing. And then I'll click Next Task. And here's the ratios table. Now we've got the settings and we've got all those and it's showing. And I'm just going to click here Save, because you want to save these things. Then you won't have to go through this again. But unlike in the other tables, I'm going to go to the wizard here. We have in Business Plan Pro these standard financials. So I'm going to say eating places, and I'll do a search. And I do know that one of our examples here is cafeterias, and as I click that, you'll see that we have some standard ratios: accounts receivable, probably not relevant; long-term assets, sales growth, 1.65%. These are standard industry financials. Now, I would want to make sure that my students understood at this point that it isn't that you have to actually match these. It's that if you don't, you have to explain why you're different. But also here you'll see gross margin for cafeterias is 58%. I'm going to import this into my profile and then go back to my sales forecast, knowing as I do the direct costs that the standard is 58%, and then that will help us guide the discussion. So let's go back to sales forecast. First, I clicked, of course, onto the spreadsheet from the wizard, but let's go back here and go to our sales forecast. And now we're going to, I think we can close the outline again. And here we are with direct unit costs. Well, let's do something creative. We want it to be about 42% overall, because we know that's the industry average. But knowing that doesn't mean we have to be exact. I think coffee has a much lower average cost, so 20% on coffee. And to make the overall good, let's say that our lunches cost us 50% of the price, and our beverages cost us 35% of the price, and other things cost us 50% of the price. And by filling in these percentages, as we scroll over, we now have a gross margin that we've assumed. And I don't know yet whether it's 58%, but at least we have something to write to. And if we're talking to investors or whatever, to the extent that it's different from 58%, we're aware of that. We have some idea of what the industry average is, and we know why we're different. So with that, there's the sales forecast exercise that I'm going to recommend you do in Session 7 as part of this class. Thank you.